Good day, everyone. It's a little bit unusual for me to not see you, but let me try this. Today is about a short summary about the COVID-19 crisis we are in and the impact on the coal market. Intercem Connect had invited me to have this short webcast, so here it is. All right, let's see if technology works. Usual disclaimer, don't worry about it. Our company, my name is Schernikau. I come from HMS Bergbau AG. It's a company headquartered in Germany. We've been in the business for over 25 years and active primarily supplying into the cement industry for many decades. We're active in Indonesia, Africa, Middle East, Europe, and as well as the US. Myself, personally, I've been in the business for over 17, 18 years and have actually become quite passionate. People who know me can vouch for it. All right, COVID-19, the current crisis we're in. We have seen a lot of data in the press every day, and one of the things that we may have seen is how the economy is impacted. And this is what I would like to start with, put things into the grand perspective. I mean, look at China alone. This is China GDP quarter-on-quarter percentage. Now, the first quarter in China dropped by over 20% in terms of GDP. Second quarter will drop, not as much, but it will drop significantly. That means we'll have a significant recession for the first time in decades in China. Now, more interesting, on the left side, if you see my mouse, you can see that the housing market has also had a huge drop. The square foot initiated dropped by almost 50%, slight recovery already. And interesting is on the right side, you see the domestic auto sales dropped in China alone by 80%. Now it's down to 40-50%. Retail sales are also in China down by 20%. Now this is just domestic demand, which will drop and will mean also less production. Now, the second impact we will see is the global demand slowdown, and that means Chinese export demand will not be there. So there will be a double whammy coming onto China. It's going to be a tough year ahead. This one is interesting. It shows the unemployment in the US. And you can see that today we are already, this is 22nd of April, we're already at over 13% unemployment rate. That is higher than we've seen in the past 15 years, higher than we've seen after the Lehman crisis. Now, the American Cement Manufacturers Association estimates that we'll reach over 25%. Some people, including St. Louis Federal Reserve, estimates will reach over 30%. That is unbelievable. So domestic demand in China we saw, now in the US as well, and you'll know what happens in Europe, exactly the same. And there will be more unemployment to come. This is only the first round we've seen, and the next come from this domestic demand decay as well as working capital evaporation. So it's unseen in the history of the US. And again, putting things into perspective, even a longer, wider time frame, this is the real GDP percentage total drawdown from the previous peak for the past 100 years. And estimates by McKinsey go that we'll somewhere reach in the 8 to 13% drop in real GDP. And that we have not seen since World War II. We may even surpass it. We'll see what happens. So it's a significant event we're seeing. In terms of oil demand, we've seen the negative oil prices last week for a couple of days because of not enough storage. And the IEA is just confirming that what we know is that the oil demand in the US, in Europe, is hugely down. China not as much, India not yet as much. But the Western developing nations, their demand slowdown will basically affect every business, including the energy business. This is from summarized by BCG, but actually the data comes from China, from CQ Coal, and and it shows the Chinese New Year, which is day 0, how the coal demand drops from 60,000 tons or 600,000 tons per day down to 50,000 tons per day in some of the large coal-fired power plants, and then usually you see the black line, it goes up back to normal. Now this year, it stayed down because of the corona crisis, and has started to come up. We're probably now at 70-80%. Now the question is what happens here beyond, and that is what you saw before. I don't predict we'll reach back the normal levels. Now, back to the global coal business. I like to start with this just to give you an understanding of the actual amounts of coal out there. So we have an 8 billion ton producing market worldwide, of which about 1.5, 1.4 billion tons are traded, of which about 1 billion tons are steam coal traded globally via seaborne markets. And the cement market has a significant share in this. I don't know how much, but I would say, well, not that, maybe 5% or so. But we'll go into the various demand supply regions to give you a bit more color. Now, globally, this 1 billion tons of traded steam coal primarily comes from Indonesia, almost half, Australia, Russia, South Africa, and Colombia. Those are the 5 main supply regions. On the demand side, you have, of course, Asia as a whole, over 60% without India. You have India, 200 million tons. Europe has become insignificant, used to be the biggest importer, today is less than 15% of global demand. And then you have a few other regions. Now, what will happen is, of course, this drop in demand that we've just discussed in those main importing regions. When you go into Asia, the large Asian market, you will again see the Indonesia, Australia, Russia, and South Africa supplying into those markets. And on the demand side, you have 6 regions we have to watch: China, India, Southeast Asia as a whole, Japan, Korea, and of course Taiwan. And again, you'll see China down as we discussed. We don't know how much because domestic production is so large in China that the import depends very much on how the domestic production compares to the total demand. My personal prediction is that actually domestic production is quite strong, total demand remains low, so we may see a significant drop in the imports in China, which will hurt the market. We don't know if that will happen. India, we will see already the lockdown has been now extended for another month until early June, as far as I remember last week. That also means lower consumption. Again, domestic production probably relatively strong, so we'll see a drop this year. And then, of course, the other Asian markets will go down as well. Now, how will the supply market react? It has to react. And who will have to react? Primarily Indonesia. So Indonesia will have to come down significantly in terms of supply. The producers have to act. Not yet done much, but this year will be tough for those producers in terms of volumes. Now, going back one step. This is a one-time event. In a year, hopefully, it will be over. There will be long-term effects. However, the fundamental demand is not impacted by this. And the fundamental demand you can see very well here, which comes to the power consumption per capita. On the left side, coal importing countries. On the right side, coal exporting countries. And what you see is that those developing nations are significantly below the world average. So as the population increases, not only does that create more demand, but also demand per capita needs to go up and will go up. So energy demand will rise no matter what. This year is a tough year. We talk about demand supply this year, but long term, we don't have to worry. This is an interesting view from McKinsey for the next 30 years. And McKinsey projects that the total coal demand until then will drop significantly, probably 50%. Now they project India going up, they project Asia going up, non-OECD developing nations going up, Africa stable, developing nations, Asia slightly down, of course Europe down, US down, but interestingly, they are projecting that Chinese coal demand as a whole will grow in the next 35 years. What is interesting is the assumptions they make. One assumption is the cost of wind and solar will become lower than conventional. Now, people that know me also know that I have a very strong view and I believe proof that actually the more wind and solar you put into the system, the higher the cost will be. So I believe that's not quite the case. Now, strong growth in India and non-OECD Asia, obviously we trust that. Africa, no growth expected in the next 35 years in terms of coal. I would put a question mark on that. And then this big assumption that China will have reduced coal demand, which will be the main reason for this drop in demand. I would also put a question mark there. We honestly do not know. It happens much on their nuclear program, but I don't see a significant drop as McKinsey does, so I would put a question mark here as well. Now, next slide, I go to the Institute of Energy Economics of Japan. It's like the IEA of Asia. And this is their view until 2050, and you can see that actually the global coal production driven by demand will not go down in the next 35 years as per their projections. I believe in that, and I have a similar view. And one of the reasons why that is actually has to do with this. Asia cannot install renewables the same way Europe has done it. Forget economics, forget the problems with wind and solar. There's just not enough wind. This is the wind atlas. I downloaded this myself just a couple of days ago. This is the European wind atlas. This is the Asian wind atlas. There's not enough wind. So that means Asia will have to use fossils. There's just no way they can survive on wind, and solar also not. Now, going back to coal, next 5-year or 4-year view by IHS. And interesting here as well, the IHS before COVID had forecasted that the seaborne demand will increase slightly, driven by India, Vietnam, Philippines, Bangladesh, Africa and Pakistan, and of course the developing nations going down. All of these things remain true. Also, IHS had projected a drop in China, which we simply don't know in terms of seaborne demand and supply, as we discussed before. But what you see now, because of the COVID, of course, that these demands, some of this demand, especially India, will go down. Vietnam, not as much. Others, these, not as much. India will go down. Developing nations will go down. Now, in terms of pricing, this is the price for the almost 20 years. And you can see that we have reached, now, this is, you can probably is driven by cost. We've reached now price levels which are almost unprecedented. Literally, I would say we haven't seen this in 15, 16 years. What does it mean? That means if you can buy now, buy coal. If you have liquidity, put it on stock. Coal is not going to get much cheaper. A few dollars here and there, but in the end, freight is down, coal is down. Producers are in a difficult situation. If you have demand, and you will have demand in the next months or even half a year, buy the coal now. Prices will have to go up. This is not sustainable where we currently are. And we've seen this demand drop for 5-6 years until 2015-16, which you may remember if you've been in the industry long enough. And this one now was, of course, much faster. Now, this is this year, or actually the past year, 1 year. And again, you see the significant drop we've seen just in the past months. And this indicates to me that this is the right time to get into the market to buy if you have the capacity for that. Companies will go bankrupt, and the downward potential is simply limited. Now, one interesting point to keep in mind, of course, are currencies. And this is just the rand as an example. So we have seen currencies tumbling significantly because of the COVID crisis. The dollar has gotten stronger. And some of the main currencies you've seen, Australian dollar down, rand, of course, down, the Russian ruble down, the Indonesian rupiah down. So the US dollar is stronger, local currencies are weaker, which is, of course, something to watch as well in this entire scheme of things. Now, one more slide I would like to share. This comes from Parrot, which shows the global coal inventories over the past 5 years, quarterly. And you can see that we've now reached already coal inventory levels that are on par with where they were 4 years ago when the price was reaching the bottom. And this will likely go up further in the second quarter of 2020. So again, an indication that there's an imbalance happening, right, which is an opportunity because prices have very limited downward potential. One more slide before we wrap up. This is just the Chinese import demand to make you aware of the volatility in that market. Generally, China stops buying towards the end of the year because they reached the quotas. In 2019, you see they almost imported zero in December. Oops. And then in January again, they reached a high level. So this huge volatility you see in the imports, of course, a significant impact on the market, and you will see that going forward as well. China is the big question mark, always has been, always will be, but generally, you know that Chinese demand will go down. Okay, I'll wrap it up here. Any questions, please contact me directly. Pleasure to be in touch at least this way, and look forward to see you soon again in person. Thank you.